Sector ETFs like XLV and XLK get labeled safe, but the price ranges expose a different bleed. XLV chops endlessly while XLK swings violently. Caution traders who ignore these ranges. Today we're going to equip you with how to spot these traps through real-time charts. Today we're getting a safe ETF myth that may be bleeding you dry by Pajama Trader. The safe ETF trap. The safe ETF myth may be bleeding you dry. XLV and XLK levels reveal that the real trap many traders fall into. Picture a split chart showing XLV stuck in a choppy range from 150, the mid-range, and 150's resistance, while XLK swings violently between the low 140s and the mid 140s resistance. Safe ETFs like these often grind sideways or whipsaw violently, quietly draining your portfolio without the trends you expect. Today we bust the myth hurting your returns. Many call XLV defensive and XLK diversified tech, but levels don't lie. XLV range is tight, XLK swings hard. Today we'll get into or dissect the safe bleeds without the level of respect. Why safe still bleeds? XLV gets pitched as defensive healthcare, but it's really chopping endlessly between 150 support and 150's resistance, delivering a low trend momentum and high frustration for buy and hold traders. XLK promises a tech growth basket with diversification, yet it shows volatile swings from 140 support to 140's resistance, hitting multi-percent moves in mere days. The big myth is that sectors equally safety reality is also revealed and dictated the levels in every time. XLV feels safe until a crash, but buying 150's resistance means reverts to you and support. Lagging S&P, the XLK temps chasers to enter mid 140's resistance and exit low 140's panic. Plot the levels first. Pull up the XLV charts. What's your rule entry here? XLK versus XLV breakdown. I wanted to go over XLV levels. So you see that you got a volume push here, and this was sitting probably around 158, but support at a 150, and seems like it was range bound for about a week, maybe 2 weeks, and then all of a sudden you finally got a break above, but now you got a rejection at that level because there was not enough volume to hold those areas, and now we're looking at a possible reversal. The XLV signature bleed happens when you buy defense right now at the top of the range, leading to show a grind back to support while missing the broader market upside entirely. XLK's hero level returns over years clearly hide its volatility, where resistance buys followed by support sells quietly transfer wealth from you to patient trend followers. Key lesson: volatility completely ignores safe levels, so always manage these ranges just like you would with individual stocks. XLV stability is stagnation. It's lagged 3 years. It lagged the market for years. XLK outperforms long term but crushes mistime entries. Volatility drag hits hard. Geometric returns equals arithmetic minus half the variance. So let's calculate the XLK's recent swing together. How bleed happens in real time. XLV traps traders in endless chop from 150's support to high 150's resistance, delivering solid but lagging performance over 10 years with the choppy bleed risk that feels defensive until it doesn't. XLK swings hard between the low 140s and the mid 140s resistance as the top performing sector with high volatility. Where swings bleeds hit despite its long-term edge. Apples to apples, XLV seems defensive until the range is trapped. XLK diversified until volume strikes. Which bleeds more for buy and hold? Talk it out. How does it shift your sector rotation rules? The key takeaway in action. Wanted to do a quick recap on the XLK levels, which is the tech sector. So right in the beginning of November, you had this big sell-off and pretty much fell in line with about 143. And currently it's trading about $3 above that, but with less volume. But then we have a volume push that was Friday. And as long as it's holding these areas, it looks like it can probably reach and close this gap before maybe running into some resistance here. But it has basically been range bound since it hit that 150 area. So another test there. Looks like it could probably send it lower because there seems to be sell-off volume happening in these areas down here, as you can see. And as long as it's trading below that, it looks like it's probably going to chop and fade lower and possibly close this gap in the next few months. Scenario 1 unfolds with XLV rotation after a scary headline. You buy at resistance and steadily bleed back to support with no real recovery. Scenario 2 hits when chasing XLK after a hot run, entering at resistance top only to panic sell at support and lock in losses. The fix is simple. Always enter mid-range. Respect the volatility bands and size positions based on realistic swing potential. Scary news spikes XLV to resistance. Don't chase it. Tech rally pushes XLK to resistance. Mid-range is your edge. Map a recent XLV bleed on your screens and spot it as a group. ETFs like these are powerful tools, not comforting teddy bears. Prioritize levels over misleading labels every time. Always respect the ranges, baked in volatility, and true historical performance against the broader index to avoid the bleed. Action step. Audit your safe holdings right now and plot those levels today. Ditch safety myth. Embrace levels. That's your compounding edge. Session close and recap. We've exposed how XLV chops between mid 150 support and high 150s resistance, while XLK swings from 140s support to 140s resistance, proving safe ETF levels hide real bleeds from poor level timing. Volatility trumps safety myths. Buy mid-range, respect bands, and size smart to capture edge over buy and hold traps. Your action: audit holdings, plot levels, turn analysis into profits. Key wins beats labels every time. XLV and XLK traps identified. Volatility drag decoded. You've got the tools to stop the bleed. Big trades, big ideas next time. Keep leveling up. And thanks for tuning in.